I mean, that's why, when you look at like a country's energy policy, I mean, every dollar in gas, costs a family of four, $3,000 to $5,000. So if you got a good energy policy, you can lower costs for people and they can afford, they have more money in their pockets. And I think, people have really in the last 18 months seen this and they're like, whoa, wait a minute, are we really heading in the right direction by doing what we're doing? I mean, I again, just to let you know what I do every day is I'm on a lot of calls looking at long-term trends and, the EV long-term trend. Everybody's like, oh yeah, everybody's going to go to electric vehicles. And there's a very, very good money manager. I've used them for 15 years with my clients' money. And he did a very deep dive the last year about the total replacement of cars and the life cycle and et cetera. And he's like, people are under the impression that we're going to go EV in the next 10 years. He's like, it's going to take,
not a goddamn chance.
Yeah, it's going to take 50 to 60 years to get out there.
And not only that, how do you get the batteries? How do you make the batteries with fossil fuels? How do you dig the nickel out of the ground with fossil fuels? Yeah. Like I do fully support investing in EV. I support investing in nuclear because that's just another market to compete with the oil to bring the cost down.
Yeah. Well, back to your point.
Well, you need both. You need all of them. You need to create the marketplace. You got to create the market.
You're seeing what's going on in the UK, and all of a sudden people are saying, well, wait a minute. We need a portfolio of energy. We need fossil fuels, renewable, nuclear. We need a portfolio because if you concentrate all your dollars on one area or the other, and that's what's happened, is that there's been less money spent, in the fossil fuel area the last 10 years. It's gone to, renewables. It ain't going to happen. I mean, our infrastructure is just not there. For example, for every EV, if you buy an EV for your house, it increased your electricity use by 50%. 2 EVs in your house, two electric vehicles, you would double the electricity that your house uses. Yeah. Our electric grid, look what happened in Dallas, down in Texas, et cetera. They can't handle it. So,
California as well.
So I think what's happening is people are sitting back going, wait a minute, we need a portfolio of energy. Who does energy really affect? It affects the middle class because costs have gone up, and it's part of inflation. So what do we do to do this? Well, we got to talk about our infrastructure. There's that conversation that is subliminally happening. I think it's got to be out there a lot more. Like, what do we do, to get the price of, gasoline back down? Because that's what you and I pay at the pump every day.
Well, I have an idea. Because I agree with you 100%. That's a piece of the puzzle as to why gas prices are so high. Supply chain is another reason why gas prices are so high. But gas prices are also so high because it's a monopoly. It's also monopoly. Like, they're price gouging. They are price gouging. They have admitted they are price gouging.
Well,
because they can.
I'll take the other side. Yeah, it's not so much price gouging. And again, I've done a deep dive on the energy sector.
Okay.
It is the best performing sector this year. And one of the things that the energy companies used to do is they'd be like, drill, baby, drill, 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 drill. And they were drilling all the time. And what was happening is they were just spending so much money on capital that you as the shareholder were sitting back here going, wait a minute, you're spending all this money on capital. It would be like building a car facility to produce 1 million cars when you're only driving 1,000 cars. So they were wildly overspending on capital. And then you got some shareholders that came back and said, wait a minute, you can't be spending willy-nilly. We need to get some payback for the capital that we're risking by investing in your oil company. And so now you're in a situation the last 5 years where they're actually being the stewards of their capital. The problem with that is that you're right. I mean, then prices of their product have gone up and we're paying for the price of the product. Now, I was on the call, the ExxonMobil call, and, there's a lot of things in the work. So one of the things that, just to talk about gasoline prices, what ended up happening, created a perfect storm. You shut down the refineries. You sent all the workers home because of COVID. Nobody was really driving their cars. Well, then they started driving their cars again. It takes anywhere from 6 months to 9 months to get the refineries back up because they got to be re-permitted. They've got to be tested. If you're not to get into how gasoline made, but basically you're boiling stuff at super high temperatures and pressure, you've got to test all those systems because you don't want to flip the switch, turn it on, and have the place blow up on you. So there's a ramp up time to start those factories, gasoline factories up, which happened. Well, the CEO of Exxon was like, people have to understand, we also had a moratorium on refineries for about 3 years. He's like, by 2023, 2024, there's 3 major refineries that are coming on that are going to produce more, gasoline, diesel fuel, et cetera. So we're kind of in that bridge mode. The question is, if you really wanted to bring down the price of energy, what's the number one thing big companies love?
Tax cuts.
You got it.
Tax cuts.
Exactly. So,
that's a great point. Taxes. Actually, I do want to get to taxes, but I want to ask one quick question on oil. I do want to also make note. A price of a barrel of oil, easy for me to say, was negative in 2020.
Yep.
Right. So they lost so much money. It makes sense. They need to make that money back. Right. Yeah. That's just again supply, demand, and supply chain.
Right. Mm-hmm.
But how do you make sense that they got to do all this? They lost all the money, and it's going to cost more to get it back. With the inflation, shouldn't it cost more to produce? So it doesn't make sense that they also have record profits, all-time highs.
Right.
So how do they have all-time highs if the cost to make it is so much more? That's a question across the entire economy because there's a lot of corporations that have all-time highs, price hikes.
Right.
So how can you say that's not a form of price gouging?
Well,
if it costs more to produce and to get out there, you should see profit. But record profits, like how does both of those things, polar opposites, happen at the same time?
Well, the big thing in the oil industry is, again, they're not burning through cash flow like they were before, building new plant equipment, drilling, et cetera. They pulled back their capital spending, dramatically. And so they're making more money, even if the labor costs are up. But I mean, to drill an oil well, costs about $10 million. And they were literally drilling thousands of oil wells. And they're like, okay, we're not going to do that anymore because we already got thousands of oil wells out there. So we don't need to do that. So again, back to your point about debt, you had oil companies issuing debt right and left, having to service that debt because they were drilling and making plant and equipment, et cetera. Well, if you're not doing that and you don't need that much debt, well, then your profit ends up going up. And that's why they're having record profit, because they're not issuing so much debt that they have to service. So I think we saw this back in the 80s, like after the disaster of the 70s and the oil embargo, et cetera. Oil companies really took a huge hit. And then in the 80s, they came back pretty strong. But, through the 2000s, oil companies, everybody wanted, and this is what's fascinating about my job, is to watch the sector rotation, from big cap and tech. Now we're going back to oil, and where the profits are. So, that's really what I do all day is I'm looking at clients' portfolios and saying, okay, what kind of money manager do we want to hire? Are we more value right now? And actually value tends to be overweighted in banks and energy. Or do you want to be in growth, which is in, technology stocks, et cetera? So, one of my other theses is that, again, right now, I think technology is deeply oversold. We could have probably a vicious bounce over the next couple of months. But, we see the same thing happen with investors. Investors get an idea and all this money goes to large cap growth core types of stocks. And one of my other theses is back in the 1980s, one of the best performing sectors was small mid cap stocks. Reason being is that if you're a company and you want to build you're like, hey, we need another division. It's going to cost us $2 billion to build this division. Well, wait a minute. We can buy that company for $1 billion. All of a sudden, one of the other earmarks of the 1980s was tremendous mergers and acquisitions. I think we're on the cusp of that again. I think you're going to see some companies merge that you will have never believed were going to merge. And I think it's going to happen in the next couple of years because in an inflationary environment, it's cheaper to buy somebody than it is to build that plant and equipment is what it ends up being. And that's what kicked off the 1980s. I mean, people need to Google Michael Milken, the junk bond king, because Michael Milken was like, hey, if I buy this company and for 40 cents on the dollar and I break it up, it's worth 120 cents on the dollar. Wow. All of a sudden you saw companies merging and getting together. And guess what? Beneficiary of that was the shareholders, and a lot of the employees at the companies became rich overnight because they held employee stock and their company got bought out, and all of a sudden their net worth doubled or tripled. But I think the other thing, to do a circle back, which I learned from my sister-in-law, stand-up comedian, tell the joke at the beginning, then you tell a long story, and then you come back to the joke.
And you get the punchline.
Right, you get the punchline. I think why it's very important for people 18 to 35 is you're going to see the largest transference of wealth ever. I mean, the baby boomers are generating.
There's a few trillion. Yep.
Yeah, and so and we're seeing it already. I mean, in our practice in the last 2 years, we've seen some major estates end up getting transferred to much younger people. And it's a little scary. Of course, everybody does the same thing. The minute they get the money, they either buy a house, they improve their house, but I keep telling these people, you have an opportunity here to set up the education for your kids and set up your retirement for the future too. And I think this transference of wealth is people are really not focusing on that tidal wave that's been happening, and it will do nothing but accelerate. But again, here's a circle back. If we move politically more to the center, if we have more libertarianism from a political standpoint where people say, leave me alone, if we have a portfolio of energy rather than focusing on one particular energy product out there, I see nothing but upside.